I'm Reed, just a normal 27-year-old guy talking about building wealth and getting your life together in your 20s outright. Let's cut to the chase. No sugar, coding, no flowery language, just brutal honesty. You're probably feeling it in your gut. Every trip to the grocery store, every fill-up at the gas pump. That uneasy feeling that your hard-earned cash is evaporating faster than a free sample at Costco. Well, you're not imagining things. Inflation just slapped us in the face with a 4.2% increase. That is not just a number on a screen, my friend. That is your future, your dreams, your ability to buy that house or retire comfortably, slowly but surely being eaten away. This isn't some abstract economic theory. This is real life, real money, and it is happening right now. This 4.2% jump isn't just a little blip. It is the highest inflation reading we've seen in 3 years since April of 2020, 3 to be exact. And guess what? It has landed on our doorstep just days before the Federal Reserve. Those mysterious folks who pull the strings of our economy are set to meet and decide what to do with interest rates. Now, if you've been following along, or even if you haven't, a few months ago, many of us, and yeah, I'm raising my hand here too, we were all convinced the Fed was going to be cutting rates, making borrowing cheaper, stimulating the economy. Happy days, right? Well, surprise. The conversation has done a complete 180, because if inflation keeps climbing, and guess what? It is, then interest rates, my friends, are going to stay higher for longer. Way longer than anyone initially thought. This isn't just a slight detour, this is a whole new road trip, and we need to adjust our GPS. So, what did this latest inflation report, this economic gut punch, actually tell us last week? And more importantly, what the heck does it mean for your money? Let's dive into the nitty-gritty, the cold hard numbers, the Consumer Price Index, or CPI, which is the headline number everyone talks about, increased by 0.5% in May alone. Now, you might hear that and think, oh, 0.5%, that is not so bad. A rounding error, right? Wrong, my friend. Horribly wrong, because that is just 1 month, one single month over the last 12 months. The headline CPI inflation is now running at a scorching 4.2%. That is the number that is keeping a lot of smart people up at night. It is the number that should be keeping you up at night too. But here's where it gets a little tricky. Because the headline CPI, it is like looking at just one page of a multi-chapter book. It only tells part of the story. There is another number, one that a lot of economists, including the Fed itself, pay even closer attention to. It is called core CPI. Now, core CPI, it strips out the really volatile stuff, like food and energy prices. Why? Because those categories tend to swing wildly, like a pendulum on a broken clock, and we're seeing that volatility play out right now, especially with energy. So, what is the verdict on core CPI? It increased by 0.2% in May, and is up over 2.9% year-over-year. Now, 2.9% might sound better than 4.2%. But here is the kicker. It is still above the Fed's long-term inflation target of 2%, a target they've been chasing for the last 4 years. Let that sink in for a moment. Even when you take out the cost of your groceries and your gas, inflation is still higher than what the Fed wants, and it is still going up. Now, I don't want to just brush off food and energy like they're some minor detail, because they are anything but. They are incredibly important. Food and energy, oil and transportation. These are the things that impact our everyday lives. They hit our pocketbooks, our wallets directly and painfully. We rely heavily on these costs. And let me tell you, the numbers are brutal. Energy prices alone, in the past 12 months, are up over 23%. 23%. Think about that. That is not a typo. That is a massive jump, according to most reports. Energy now accounts for about 60% of the overall increase in inflation during the last month. So yeah, energy is a huge reason why we're seeing inflation spiral upwards, and of course food prices, we don't need a government report to tell us they're climbing, do we? You see it every time you walk into the grocery store. The food index is up 0.2% last month in May, and is up 3.1% year-over-year. Look, like I said, most families, most people, we don't need some official report to confirm what our eyes and our wallets already tell us. That $50 grocery haul from a few years ago now costs you $100. We feel it, we see it, every single time we go to the store. And let's not forget about housing. The shelter increase, as they call it, which measures the rise in housing costs, was up 0.3% last month and is up 3.4% year-over-year for many families. Housing is the biggest chunk of their monthly expenses. So when the cost of putting a roof over your head goes up, it puts pressure on every single penny in your wallet. There is no escaping that. So why does the stock market care about all this? And more importantly, why should you care? This inflation report, it is not just about what you pay for groceries or how much gas you put in your car. It has a ripple effect across the entire economy. It affects interest rates on loans, it impacts the cost of stocks, it influences bond yields, and it shapes the broader economy. This stuff is incredibly important because it touches every aspect of our financial lives for most of the past year. Many investors, myself included, we've been living with this assumption that the Fed funds rate was going to come down, that the Fed would lower interest rates, making money cheaper to borrow, and that would ignite everything. Lower rates usually incentivize people to borrow money, which often boosts housing. Mortgage rates tend to follow suit. They're tied to the 10-year Treasury, but they generally move in the same direction, and stock values are also affected by interest rates. But here's the curveball, something we haven't really seen in a few years. When inflation starts accelerating upwards, it completely flips the script. Everything we thought just a few months ago is out the window, because now inflation is moving in the opposite direction. It is going up. And that means the Fed has a lot less wiggle room, a lot less flexibility. When it comes to lowering rates, why? Because when the Fed makes money cheaper to borrow, people go out and spend, and that spending, my friends, is inflationary. When demand goes up, prices go up even higher, but we're already dealing with high inflation, which means the Fed might not be able to cut rates like we all hoped. And that is why these inflation reports generate so much attention. Not just from investors, but from everyday consumers like you and me. Let's keep talking about the Fed because they're kind of a big deal here. Their target for core CPI for years has been 2%, not 4%, not 5%, not even 3%. They want it at 2%, and guess what? It never got there. It got down to about 2.6% or 2.5%, and then it started climbing. Core CPI is up to 2.9%, and that headline CPI with food and energy included is a whopping 4.2%. So it is going in the wrong direction, and that creates a huge challenge for the Fed. They can't just waltz in and lower rates anymore because higher inflation means the Fed actually wants to slow down spending. They want to make people think twice before taking out loans. When inflation is raging like this, and what is their usual weapon of choice to slow down spending? You guessed it, they raise interest rates, making money more expensive to borrow. When borrowing gets expensive, people spend less. And that is what usually brings inflation down. And that is why you're starting to hear some whispers, some murmurs, that the Fed might actually raise the Fed funds rate in the next few months, maybe even at their upcoming meeting. Now, the general consensus right now, with just a few days to go before that meeting, is that the Fed will keep the federal funds rate right where it is, between 3.5% and 3.75%, and not touch it. But I'm telling you, if we keep getting these inflation reports showing prices climbing higher and higher, the Fed is going to have to step in and raise that rate. It is not a matter of if, but when. The Fed is meeting again in just a few days. And this FOMC Federal Open Market Committee meeting is going to be incredibly interesting. It is the first meeting for the new Fed chair, Kevin Walsh. And get this. Jerome Powell, the previous Fed chair, is going to be sitting right there on the FOMC as well. That creates some unique dynamics, some potential friction in terms of leadership, something we haven't seen in decades. We haven't had a Fed chair stay on the FOMC since the 1940s or 50s. It has been a long, long time. So we might see a little drama, a little disagreement about what the Fed should do at this next meeting. We'll have to wait and see. But again, the bigger issue isn't just what the Fed decides. The bigger issue is what happens to our wallets if inflation keeps spiraling upwards. So, let's talk about what this means for us, as consumers, as investors, because that is the bottom line. That is what truly matters. It means borrowing money is probably going to stay more expensive for longer than any of us anticipated. Credit card rates. They're going to stay high, car loan rates, also staying elevated, and mortgage rates. Even though they're not directly tied to the Fed funds rate, expect those mortgage rates to stay higher for longer too. This isn't good news for anyone looking to borrow, looking to buy, looking to expand, but, and there is always a but. Let's look at the flip side. When the Fed funds rate stays higher for longer, if you're a saver, you might actually benefit. Why? Because it means the rates on your high-yield savings accounts are going to remain higher for longer. It means the rates you're getting on CDs, certificates of deposit, and money market accounts, those rates are going to stay elevated too. So if you've been diligently saving, you might actually see some better returns on your cash. But again, I don't want you to get too caught up in what the Fed might or might not do. We don't control the Fed. We don't control inflation. We can't control energy prices or what is happening with oil and gas in the Middle East. We can't control any of that stuff. It is outside our sphere of influence. But here is the critical part, what we can control. We can control our financial habits. We can control our spending. We can control getting rid of bad debt if you're carrying any high-interest credit card debt. Now is the time to aggressively tackle it. These are things that are within your power, within your reach. You can also control whether you're consistently investing for your future through something as simple as dollar-cost averaging. Keep investing no matter what is going on around you. Don't panic, don't pull out. Just keep going, keep putting money into your investments regularly. The next inflation report is coming out on July 14th, in about 3 weeks or so. And at that time, we're going to find out whether inflation continues its upward trajectory or if this was just a temporary bump in the road. A little blip before things settle down. We'll have to see, but keep your ears tuned to this channel because I'm going to break this down for you in plain language every single week, so we all know what moves we should be making with our money right now. Based on what is happening in the broader economy, with inflation, with the Fed funds rate, with GDP, and all these larger issues that impact us. So let me hear from you. What do you think? Do you believe the Federal Reserve should raise interest rates again to try and slow down spending and keep inflation in check? If that is even possible, or do you think the Fed should just keep interest rates exactly where they are right now and simply wait and see what happens? Drop a comment below for me and let me know your thoughts. I'm genuinely curious to hear what you all think, and if you got any value from this video, please do me a favor. Share it with someone you think needs to hear this message. Spread the word. Let's help each other. Step Financial Reset is open right now. If you're tired of feeling financially scattered, like your money is all over the place, and you want a clear system for managing your money, for growing your money, for eliminating debt, for building up cash reserves, and for truly understanding investing at a deeper level, I'd love to work with you in the 4-Step Financial Reset. The program includes the complete 4 steps to maximize your money course. 3 small group live coaching sessions with me, worksheets, tools, and support. You can learn more about the 4-Step Financial Reset in the link below in the description box. Remember guys, the best person who is going to take care of the old you is the young you. Until the next video.